Well, it's time now for some business news, and we'll start with the spectacular fall from grace of WeWork. The company, once valued at an extraordinary $47 billion, has now filed for bankruptcy in the US. Charles Pellegrin is here to tell us more.
Hi, Haxi. Definitely a humbling turn of events for the co-working space rental company that is backed by billions of Japanese group SoftBank. WeWork has been struggling with the expensive rental agreements it had signed before the COVID-19 pandemic and lower than expected occupancy rates because of the rise in remote work. The company said it had struck an agreement with almost all of its creditors to convert some $3 billion in existing loans and bonds into equity in the restructured group. Filing for bankruptcy means WeWork will be able to terminate leases early with minimal financial penalty. It currently has $13 billion in lease obligations that need restructuring. The company saw a meteoric rise after its creation in New York in 2010, buoyed by its charismatic co-founder Adam Neumann. But this all came crashing down in 2019 when the group's attempt to go public exposed its heavy losses as well as corporate governance concerns. Adam Neumann left the company that year, and in 2021, finally, the company did eventually go public at a valuation of just $9 billion. Neumann did release a statement on the filing on Monday saying, "It's been challenging for me to watch from the sidelines since 2019 as WeWork has failed to take advantage of a product that is more relevant today than ever before. I believe that with the right strategy and team, a reorganization will enable WeWork to emerge successfully." Well, as we just saw, the effects of the pandemic still being felt in the economy. In Germany, restaurateurs are worried as the government decides on whether to end a pandemic-era tax break that cut the value-added tax to 7%. The current regulation is valid until December 31st, but its future is set to be decided in the next few weeks. Liza Herbert has a story.
When this chef opened his restaurant in 2020, he never envisioned closing it after just a few years. But with the coronavirus pandemic and Russia's invasion of Ukraine driving up prices of basic food items, plus rising interest rates and consequential labour shortages, keeping it open has been a feat. Now, it may have to survive the end of a vital tax break too.
The challenge for us is, okay, now we have more expensive products, now we have less labor force, and now we have to raise the prices. But if we raise the prices, people complain and they leave bad reviews. So what should we do, just close?
The German government slashed the value-added tax, known as VAT, to 7% during COVID-19 lockdowns. Now, that number is expected to rise to 19% by the end of the year. According to the Finance Ministry, it would cost €3.3 billion to keep the tax break in 2024. However, the German Hotel and Restaurant Association says ending it would lead to perilous outcomes.
12,000 businesses said they would then give up. They would then close because they see no prospects. And I think you have to take that very seriously.
The association also estimates that 93% of business owners would have to pass on a tax increase on meals to their customers, many who are already facing budget constraints as the cost of living rises.
Let's take a look at how the European markets have opened this Tuesday, all trading lower as the positive momentum from last week's Fed decision to pause interest rate hikes has stalled. As you can see, the Paris CAC down just under 0.5%, the DAX in Frankfurt down over 1/3%, and the FTSE in London down 0.25%. Let's look at the Asian stock markets this Tuesday as well. Most major indices and all major indices there trading lower as well. The Nikkei down 1.34% at the close. The Hang Seng in Hong Kong down over 1.5% as well. Chinese trade data, the main concern there, investors parsing through all that data showing a 6th consecutive month of a decline in exports. And Swiss banking giant UBS is feeling the effects of its forced takeover of embattled rival Credit Suisse. At the beginning of the year, the group posted a $785 million loss in the third quarter because of expenses linked to that deal, which was completed in June. It has, however, said that its core wealth business is stabilizing with net new money in this business of $22 billion thanks to the arrival of new customers. And finally, in the U.S., Netflix's CEO has said that talks with striking Hollywood actors were ongoing after their union failed to reach an agreement with major studios. The union said it was determined to secure the best deal and bring a responsible end to the walkout, which has lasted 4 months. They are demanding higher compensation in the streaming era, as well as protections around the use of artificial intelligence. The studios said they made their last, best, and final offer on Saturday. Take a listen to Netflix CEO Ted Sarandos.
Yeah, we're right in the thick of it, so it would be impossible for me to talk much about it. Yeah. Look, we're in the business of telling stories, and that's what we want to do every day. So it has grind to a halt for a few months, and so we're going to try our best to get things up and running and get the output back up for our fans too.
So we'll be keeping a close eye on that story, Haxi, in the days and weeks to come.
Charles Pellegrin with the day's top business stories. Thank you very much.